everyone. Welcome to Hot Forex webinar for June 18th. My name is Andria. I'm a market analyst here in Hot Forex. And today we're going to try to cover together charting patterns part 2. So part 1 was covered by Stuart last month. So today we'll have we'll go beyond that. We will see a more advanced charting patterns. Before I start though, I would like to make sure that everyone is listening to me. There are no audio issues. So please give me feedback if it's possible to our question box. Hello? Oh. Apologies for that delayed. So if any one of you is facing any audio or visual issues during the webinar, please just let me know through the question box. Also, regarding any question that you may have, I will try to cover this during our webinar. However, because we have just an hour, the maximum, if there is something that I cannot manage to answer on time, or in my more longer explanation for, please email your question to webinars@hotforex.com. So let's now have a look at our disclaimer warning. These materials provide us a general marketing communication for informational purposes only. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. We make no representation and assume no liability as to the accuracy or completeness of any information provided, and we shall not be held liable for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading Forex and CFDs may not be suitable for all investors and carries a high degree of risk to your capital. Trading such products is risky and you may lose all your investment capital. So we have done that, and just I will spend a little more minutes to introduce myself for people that have not attend my webinars before. So I'm Andria Bihidi. I'm a market analyst here in Hot Forex and Stuart's colleague, which is our senior market analyst here in Hot Forex. I have recently actually joined the team of Hot Forex. Sorry, apologies for that. I don't know what's happening. So, oh, that's very disturbing. So I have recently actually joined Hot Forex team, and I was, however, before I was in Hot Forex as well in industry for the last few years. I was anyway in Forex industry for the last few years. So I have gained a bachelor degree in mathematics and physics from the University of Bath, and I also had a master degree in mathematics and also in actuarial studies. That was all for me. My mission here, and in general, our mission here in Hot Forex, and especially in market analysis department, is to actively help you guys becoming better traders by delivering daily market reviews and reports. So please visit our website. We are daily putting some reporting there on why entering the market, on the way we are doing, where did we are based that opinion, on which technical tools and which fundamental news did we base our entry in the market. So it would be helpful for you because we explain everything in detail. So let's go through our webinar and let's start properly though. So today we'll just mention what part 1 of the charting patterns was covered by Stuart last month, and today we'll go further. We'll go beyond that part 1 webinar. So we'll see double and triple tops and bottoms patterns, head and shoulders, the cup and handle pattern, rounding tops and rounding bottoms, and see also some examples in order to help you understand clearly this pattern and how you can identify them. Actually, just a question before I start: does any one of you heard about this patterns before, or someone used them? Just a quick yes or no, or which one you are familiar to. So Constance says yes, has seen these patterns before. Okay, so Malitus never used it but heard them before. Yes, I always use them. That good, Amit. I'm glad you're here. I noticed that you're attend in every webinar. Yes, use double bottom and double top. Good. Know them but not use them before. Okay, so hopefully for people that have not used them before, that webinar is helpful for you guys. So I'll try to put some examples, like recent one. So I try to find for the last 1 or 2 months examples for these patterns in order to help you identify these patterns. So just a summary of what Stuart covered last time. So as you already know, or might not, I don't know. So there are continuation patterns and reversal patterns. So continuation patterns simply it's simply that when the trend cannot consolidate for too long, hence they resume initial trend direction. So if it was upwards and consolidate for some time, then continues upwards. That's a continuation of the pattern. So he resumed his initial trend direction. Reversal of the pattern is when it's changing its direction, when trend is changing its direction. So if it was upwards, then we might identify a reversal pattern, and we recognize that it's going downwards from upwards, or from upwards downwards. So that's the reversal patterns. In this webinar, if I'm not, in this webinar, actually, all of them are reversal patterns. So, as you know, all patterns are either reversal or continuation until the pattern is fully formed and the outcome becomes probable. So you have to ensure that the pattern that you notice, that you identify, is fully formed. This will give you assurance, that will confirm you that you are on the right path. So you have to make sure that the pattern is fully formed in order for the outcome to become probable. Patterns like that, but in general, the technical tools, as you already that you already know, do not always work. They can diminish and become continuation of the initial trend. So you have to take care. You have to, as we said, fully to identify a full formation of the pattern, either it is reversal or continuation. And also, it's good to add some more technical tools on your analysis in order to check if they agree with what you identify, with the reversal pattern that you identify, or with a continuation pattern that you might identify. So all patterns are restricted by trend lines, which is supply and demand, and patterns size actually is very helpful on setting your stop loss and your profit target. So we'll see that in a minute. But that's a very, very helpful tool of putting your stop loss on time and your target as well, in order to reduce the risk. What Stuart covered on 28th of June, that was triangles, symmetrical ones, ascending ones, descending ones, wedges, rising and falling ones, and pennants, bullish ones and bearish ones, and also flags. For those that I haven't attended on that webinar, it's in our website and our YouTube channel. So you can actually request or log in and watch that webinar in YouTube as well. So let's start. So, as I said, today we'll cover, the first thing that we're going to cover is double tops and double bottoms. So, this is a very, very common, double tops and double bottoms are very common reversal patterns. So, it's actually, let's start with the double top. So, double top can be identified in an uptrend and it give us a bearish signal. So it gives us a signal that the uptrend has like ended, is run out of steam, so it's likely to go downside. It might not be an immediate signal, or I mean a reversal. Sorry, it might take some days, depend on your time frame, or it might be done immediately. So however, if it's like if it's a fully formed pattern, it will at some point confirm. So at some point it will go downside if it's a double top. If it's a double bottom, at some point it will go upwards. So as I said, it's a bearish pattern, and you can identify it if you notice two highs and a neckline. I will explain that exactly right now. So two highs, what do we mean by two highs? So we're in an uptrend, and as you can see from my example over here, the pair, the Aussie yen in this, the daily Aussie yen in this example over here, or in general, your asset has reached the resistant level twice. So it didn't manage to break above that. So it was hidden again down, giving a support level. So the support level is given after the first top. So we had an initial top over here. We saw a support level over here, and then it tried to hit again. So buyers tried to push again the price upwards. They didn't manage to break that level, that resistance level. So they went down again. So they provided we're observing here a double, two highs. What I mean by a neckline is just the support level that was identified after the first top. So that support line is our neckline. So so in order to trade something like that, a pattern like that is when you see that our neckline, our support line is broken. It's broken downwards. So as you can see over here, we have the double top, and at this point over here on May 2nd of May, the neckline was break down. It will consolidate for a while. However, the third day, it break down even more sharply than before. So at this point, we're sure that this is a fully formed double top, so we could enter the market. So as I'm pointing in this slide, the neckline is can be used to set our stop loss. So the stop loss should be above our two highs, and the target can also be set at the same distance as high and neckline. So there are two actually ways of trading a pattern like that. The first one is the one that I just mentioned, and I have an example also. Let's go to the example first. So as I said, the stop loss can be set above our double top. The target can be set at the same distance of between neckline and the high and the top highs. So at the same distance, we could set our target. So if let's say we have here, it's nearly from 81 to 86.70, we have it's a huge actually position. So that's because we're in a daily. So we have nearly 560 pips. So we will use 560 pips away shortly to set our target as well. So I put my target around 75. So we use this distance from neckline to the top in order to set my target. so that's a good tool in order to get to set your target and not to like put it very too early or far away. So it's a good tool to use that distance from neckline to the very top. So my entry, it could be either once the neckline is break down for good. I mean, as you can see here, the neckline is at 81.11. So it was break once. However, the next day, it consolidated a little bit and became quite bullish. So we weren't sure if we should enter the market or not. The double top was not fully confirmed. However, the third day, it was break down very sharply and went down to nearly 79 in Aussie yen. So we're short that this is a fully formation of a double top. So you could apologies, guys. Are you with me? Hopefully you haven't missed a lot. Okay, I will continue. Are you okay now? Can you hear me clear? Sorry, I just accidentally pushed the mute button. Apologies for that. So let's go to the second trading method. Good. The second trading method is after neckline has been retested as resistance level, we could set the stop loss above neckline. For targets is the same as the first trading method. So targets will be always set at the same distance as highs and neckline. So let's go again to the examples. So the second example on the right hand side of your screen is the second trading method. So if you don't want the stop loss to be far away due to your margin or whatever, then a second trading method of the double top is using setting your entering the market actually once you confirm that the neckline was becoming a resistant line. So if you can see over here, it did hit it once, twice, broken down. However, it was consolidated for quite long. So we knew like for the very 5 days or whatever, so it was consolidated. So this neckline was from a support level, it became a resistant level. So since the neckline was becoming a resistance level, we could enter the market at this point over here. So now our neckline, which is our resistance line, is also our entry point. So since we saw it consolidate for quite long, we were quite positive that it's becoming a strong resistance level. So I could set my stop loss closer. So I actually put my stop loss over here because I saw that this area was hit 1, 2, 3, 4, 5, 6, 7, 8 times. That's the only reason that I set my stop loss at this point over here. You could either put it over here. That was hit even more times. So it was 1, 2, 3, 4, 5, 6. Oh, that's 7. But it's up to you to choose the stop loss. I just chose the one that was hit more times in order to reduce also to be closer to my neckline and to reduce also my position and my risk, the risk of a failure of the double top. The target, as I said before, doesn't change. It has to be the same distance. It has to be set at the same distance as the neckline and the top. So I think that's straightforward. Target is straightforward. As for the stop loss or your entry, is up to you. Do you want to confirm that your neckline has become a resistance and enter? Once you confirm that, you can enter the market at that point. If you want to get quickly in the market and set your stop loss like far away to be sure that it will not you will not get in a stop loss, then you can enter in the market once you have saw a confirmation, sharp confirmation that the neckline was broken, like sharply, like this example over here. So you could enter at this point over here and like setting your stop loss further up in comparison with the second trading method. So that was the double top. Regarding the triple top, I haven't put some examples on. It's simply the same thing. It's just you will identify 3 highs. So your pair will be hit the resistance 3 times. So it's the same formation, the same mentality. Yeah, it has to the asset has to break that support level, which is our neckline, in order to confirm a triple top. So let's go to double bottoms. Kostan has a question. It is safer to enter on the entry because sometimes pairs can move to make a triple top. It is safe to enter on the entry because so you're referring to the second actually tradable way, that is the stop loss is closer in order to not. So yeah, that's I agree with you. Actually, I have the same. I agree with you because by setting the stop loss closer, we are decreasing our risk. So yeah, in order not to in my form a triple top or something. So it's a good observation, Constant. Thank you for that. So let's go to the double bottom. So it has the same mentality, is the inverse of the double top. So as you can see of the example, it can be identified in a downtrend. So we are in a downtrend. We identify 2 lows, and it's a possible signal for a possible trend reversal to the upside. As you can see from my example over here, this is a shorter term example. It is a dollar CAD in an hourly chart. So don't think that it can be only identified in a daily, weekly charts. It's also intradaily ones if you are an intraday traders. So this is a bullish pattern because it's a reversal from the downwards to the upwards. As I said before, the two once you can see that sellers fail to push the asset further down, so they failed to break actually that support level over here that we had at around 132.70, I think. So they failed to break that support level, and so they go again up, hit into a resistance level over here at 1.3367. Try again to push down. Sellers tried to push down and break the support level, didn't manage because bulls entered the market and they are pushing the price further up. So at this point over here, we had a break of our neckline. This red line is our neckline because, as I said, the neckline it can be identified, can be set at our in this case over here at our high after the first top. So after the first top was identified, you could see that it was the first high was at this point over here. So we have set our neckline over here. So okay. James is asking, how do you derive your neckline, support line, and resistance lines? I have again two examples. So let's go through them right now. So as you can see over here, it's the same instrument, it's the same asset as before. It's also cut, but this time I put it in a 30 minutes one because I wanted for you to see where exactly where my entry was, where my neckline was, the stop loss, and etc. and the target. So I had that double top. That's clear, I think, for all of you. So they didn't manage to go below that. They the highest in this double bottom, our asset has the highest highest price at this area over here. So that's the reason why I set my neckline at this resistance level over here. So it wasn't hit too many times. It's not like it cannot be considered as a strong resistance level. However, it was the area where it was my highest price during this double top. So I have set my neckline over here. So once I saw that my neckline was broken at this with this candle over here, I wasn't sure that was indeed a fully formed double bottom. So I was waiting for a confirmation. This confirmation was given with the next candlestick. So as you can see, my candlestick opened at this price over here and pushed it very, very sharply. It was quite big candle. So once I saw that my my neckline was like broken again, and it consolidated as well, as you can see. So it became a support level. My resistance line, which is my neckline, was in this area over here. It became a good support level because the asset didn't manage to go back down again. So in this, let's say if you are intraday, this 30 minutes for this 30 minutes chart for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 12, near more than 20 times it was hit, but they didn't manage to take it down to the neckline. So this neckline was converted into a support level. So you could either enter here or enter here once you confirm that it didn't hit our new support level. So you could enter in this area over here, or waiting for a little more, or even you could wait for these soldiers, white soldiers, these bullish candles. To be sure, it's up to you whether you want to risk it and enter too early, or you want to leave it consolidate in order to confirm that your neckline it became a good support level. So you could enter the market after you saw it consolidate and after you confirm that your neckline is a good support level. Hopefully that's okay with you, James. If not, just ask me again. What exactly do you want to learn? So that's again the same thing as double top. So in double bottom, the same thing as double top. The target would be set at the same distance as the neckline and the high, the lowest bottom. So the lowest bottom was over here. So I have measured this distance and I put my target at the same distance from the neckline. So don't measure your entry with the lowest price. It will be your neckline with your lowest price. So it's this distance over here. The neckline with the lowest price, the lowest double bottom area. So let's go again with that. So as we said, the neckline is the stop loss below. In the first tradable way, your stop loss can be set below the two lows and the target set at the same distance as lows and neckline. While in the second tradable way is once the neckline has been retested at support level, as I said before, your stop loss can be set below the neckline. So it will be a nearer stop loss, and targets again at the same distance as low. So as you can see over here, I have the first tradable way where I actually set the stop loss below my double top, since I entered the market exactly on the second candle that I confirmed that it was again my neckline was broken again. So I entered at this point over here. In the second tradable way, apologies for that. I said my stop loss. That stop loss is wrong. Oh, apologies for that. I will just just bear with me. Just stay with me, and I point out where I will set my stop loss. So I was waiting. Once the neckline was broken, I was waiting for the neckline to confirm that it became a good support level. So based on these candles over here, it was confirmed that it's a good support level. So I entered the market once I saw this second big bullish candle, which is below my way above my neckline. And actually, if you go further up, it's a new high in this area over here. It's nearly close to the highs of my downtrend. So I entered in this area over here once I saw that bullish one and the second bullish one, and once my neckline was confirmed as a support level. So my stop loss here is wrong. Apologies, it stayed from the first example. So the stop loss for this second tradable way, it would be either in this area over here. You can see that it was hit too many times. So you could either set it below, so over here, or even closer, here. You can see that it was hit too many times. So, so you could set it here or here. Hope I didn't confuse you. Apologies for that. My editing skills need to be improved. So, hopefully we are fine with double tops and double bottoms. Okay, I don't have any questions, so I believe that we are okay with that. So just before we go through the head and shoulders, just a recap. We have a double tops giving a reversal. Double tops, double bottoms are giving a reversal patterns, either from upwards to downwards and from downwards to upwards. So let's quickly go to a very, very interesting one, which is head and shoulders. So it's again a trend reversal pattern. It can be identified in an uptrend or a downtrend, and it consisted by the head and two shoulders, and we have to set a neckline again. So as you can see from the examples over here, this is, so the head is the highest price over here, the highest, this triangle over here. So the shoulders should be lower. So the highs in the shoulders, in the two shoulders, left and right, should be lower than the head. So for the standard head and shoulders, which is the first example, it can be identified after an uptrend. So after an increase in market, so after our price is getting upwards and upwards and upwards, and it actually indicates that once that our uptrend is run out of steam, so it will probably go downwards. You can see it very clearly in this Aussie cat example, the weekly one. The inverse head and shoulder is exactly the opposite thing. So it can be identified in a downtrend, and it indicates that the downtrend ran out of steam, and our asset will probably go upwards from now onwards. Nila, it is risky to open in position after the market retraced at the bottom and set your target at the neckline. Oh, let me go back. Sorry, to see what you're referring to. So, is it risky to open a position after the market retraced at the bottom and set your target at the neckline? So, according to this example over here, you wanted the neckline to be actually your target. Is that I understood clearly? So you go short and not long. Is that what you're asking, Nilaha? If that's what you're asking for, I believe that's quite risky. It depends on the time frame that you are trading. So if you're like a 30 minutes one, or an intra trader, I don't know, a 30 minutes one or a 15 minutes one. No, going long from the moment it bounces up off the Nilaha is asking, no, going long from the moment it bounces off the bottom. So once you identify the second bottom to go long at this area over here, is that the question? So apologies if I'm not that's the question. So Nilaha was asking if it's good to go long from this moment over here. It would be risky. You don't have actually a formation. You don't have you don't have a double bottom at this area over here. You're not sure that it will indeed, that's the formation, that's the pattern that was formed. It's actually, you're simply seeing an asset that it went down, it tried to go up at this area over here and down again. However, you're not sure if it will continue, if that support area will break downwards. It's it's a good question though. It depends on where you will want to set your stop loss and target. So in your if you want to enter the market too early, so before actually that double bottom is formed, I will advise you to wait to see that a direction after consolidation. So if we like focus in this example over here, we had a bottom over here, then we had a quite bullish signal over here because we had many bullish candles. Then it consolidated, and at this area over here, it was break again upwards. So if I was in your position, in your position, I wanted to enter the market urgently, I will probably try to do that over here where I had actually a good bullish candle, because this candle over here, you can see it doesn't have a tail down. So it's quite a strong one. But I will set my target very, very closer and my stop loss closer as well, because it's an intraday one. It's a 15 minutes, it's a 30 minutes candle. So you will not have, probably have a few pips gain. If you were correct, like you're referring to 10 pips, or maybe if you're too risky and want to go up to here, maybe 20 pips. So it depends on your trading style, your time frame that you're using. But in order to do that, it is quite risky. So if you want to do something like that, you have to make sure that your stop loss is quite close enough and you see another signal. So another signal that I'm seeing over here is that after consolidation, I have this bullish candle that it doesn't have a lower tail. So it means that bulls enter and push up without having any sellers in that try to push the price down. So hopefully that was helpful for you, that explanation. So let's go back to our head and shoulders. We have covered standard head and shoulders. The interior head and shoulders is the opposite thing. Sorry, I have to go quite quickly now because we're like way back. So inverse head and shoulders can be identified in a downtrend, in a dropping market. So, and it can be, it indicates that we probably, our asset will probably reverse upwards. So let's go to some examples. Okay, the first example that I have here is the inverse head and shoulders. Is the same as I had in this slide over here. I just put it in a bigger picture just to see it and understand how it is formed. It's, if you can see, it was an attempt to go to take the price down from the sellers, and then bulls take the control, push it at this area over here. However, sellers enter the market more aggressively and they push it further down. So they push it lower than before. And bulls again tried to take the control. They managed to go up to this area over here. Sellers entering, make a new low. However, it wasn't. It is higher than the lowest low. So we had that formation of inverse head and shoulders. So our neckline is in this area over here, and I think this is straightforward because it's the area that was hit many times once we identify that inverse head and shoulders. So it was hit too many times. You could either set your neckline at this area over here. However, it's good to set your neckline at the high price of the formation, which was this one. You can see it over here clearly. So let's go to the two trading methods. The same thing as we did with double tops and double bottoms. So the first trading method is once you identify that head and shoulders. Not an inverse one, and standard one. In this example of standard one, I have set my neckline over here. I could either enter it. I could either set my neckline here, which was the lowest price. However, to be honest, I set the neckline over here because it was hit too many times and it was a strong support level. So I set my neckline over here. I saw that bearish, like a strong bearish candle breaking my neckline over here. So that's a strong one. It's not like here or right here that they break it one, but they revert up. They revert upwards. So that candle closed actually below my neckline. Apologies for the Skype. Let's try to close it. Okay. So once I saw that it was breaking for good and the candle closed below my neckline, I was waiting for the next candle, which opened indeed below my neckline and pushed further down, and I entered the market. So that closing below my neckline was my confirmation of entering the market. So I entered the market at this area over here. The stop loss was set, has to be set above the right shoulder. So above the latest shoulder, if that helps you further. So I didn't set it above the head. I set it above the right shoulder. It's the way of head and shoulders trading method. And the target again at the same distance from the head and the neckline. So I'm measuring the neckline, the distance between neckline and the head. And I set my target at the same distance, but short this time, because this is a bearish signal. The head and shoulder, standard head and shoulder is a bearish signal. So I set my target. I enter short, and I set my target at this area over here. So let's go to the second trading method. It's again similar to our double tops and bottoms way. So I have my neckline, I have a fully formed of head and shoulders. I set my stop loss above the right shoulder. However, I wasn't sure for my entry. So I wanted to see whether my neckline was converted into a good resistance level. So from a support level, it was converted to a good resistance level, because as you can see over here, it was broken, down, continued down, down again for 2 consecutive sessions, and then it consolidated for a while, but they didn't manage to go up to the neckline, up to my new resistance level. So I said, okay, I have to enter the market. That's a good resistance level. It seems quite strong. So I entered the market once I saw that it consolidated. So that was my entry. My entry point. Again, as I'm repeating myself, the target is at the same distance as the distance from neckline up to the head. So that was my head and shoulders and the inverse head and shoulders. Let's go to a cup and handle. I believe this is quite difficult to be identified, to be honest. Is I find it quite difficult to be identified, to be honest. For some people, it's quite easily. It's up to the experience, I believe. So the cup and handle is actually bullish continuation pattern. So up to now we have seen reversal patterns, but this one is actually continuation pattern. So you confirm that so Malito is saying that it's the first time that is hearing this this pattern. Good. I think it's I have a very recent actual example on this pattern, so we'll see it right now. So this is a continuation pattern, not a reversal pattern. So as we said, it's a bullish one. It's not a bearish one. It gives only bullish signals. So it's like it used to find buying opportunities in the market. So it can be identified in an uptrend. And once you saw that it is in an uptrend, however, your asset is actually consolidate, you don't know where it will go afterwards. It will continue downwards or upwards. So these patterns, it actually confirms that your asset will move with his initial trend direction. So I will have an example. Let's go through the theory of that. So just to see the formation, you can see that it's nearly like a cup and a handle. So that's why we call it hand and cup and cup and handle. So how it is formed, it has initially an upwards move. So you will see the price move sharply upwards. So as you can see in the example, we have a quite sharp upwards move in this area over here. Afterwards, we have identified a cap. So what actually is a cap is when the pattern, after it initially moves upwards quite sharply, after that, we see it going quite sideways and retracing, going up and down, up and down. However, this retrace over here and this quite sideways move, it should be 1/3 or at least the maximum 2/3 of our initial move. So this initial move, you can see this distance over here is like how many pips? It's nearly 140 pips. So this area over here, this sideways or this retracement that you see over here, we have a retracement, sideways, up, down, up, down. This area over here should be the maximum of 1/3 distance, 1/3 distance from our initial sharp upwards move. So it creates like a slide, like it's like you can say that is the bottom of a bowl, of a cup. So it's like a cup. So that was what I'm saying, like a cup. So we have an upwards move initially, price moves sharply upwards. We have the cap that has been overbought and it is retracing or going downwards. However, the cap, as I'm pointing out down here, should be approximately 1/3 to maximum 2/3 high of the initial upwards move. So the ideal is 1/3, but markets cannot be ideal. They go upwards, they go downwards, they will consolidate, the retracing. That's an ideally scenario. So it has to be though 1/3 to 2/3 maximum. So after we identify that cap, we're waiting for a handle. So a handle actually is after we saw that retracement of the cap, that we now see that the price actually continues again up, but more gradually, like forming a handle section of the pattern. So what I mean by that, you can see in the example. So we saw it retracing, we saw it like going quite sideways, and then we saw an upwards move was even gradually than the first one. So that's even sharper than this upwards move, and it also make a higher high than our initial upwards move. So at this point over here, we're waiting for the handle to be created in order to confirm that it's a cup and handle. So what's the handle? Is that retracing downwards. Once the highest, that high was confirmed, that is higher than our initial upwards move, we saw the pair retracing again, making lower lows, but even gradually than the initial move. So it created a handle, because after these 3 sessions, and you can see over here in this example over here, it went up again, consolidate, and up, up, up. So it created us that handle. So at this area over here, at this point over here, we can confirm, or over here, we can confirm that we have a fully formed cup and handle. So we have the upwards move, the cup, the handle, and then a continuation of the asset upwards. So we have to see a break of the handle and a continuation upwards above the initial high. So I'm repeating again that this is very significant. We have to see a break of the candle and to see the asset continues upwards above the initial high. And that's what we see in this area over here. It retraced down, and then it break the candle, consolidate a little bit, but created a new high. So this high over here is higher than the initial move, and then even actually higher than our handle. So it break the handle for good. So we have a fully formed cup and handle pattern. So ideally, retracement is not the handle. Retracement in the handle should not pass the high on the right side of the cup. So ideally, this retracement over here, this should not be like more than the initial upwards move. However, that's the ideal scenario. Is not so significant for me, because markets cannot be ideal. So, however, let's go to the tradable way. So, you've been on long entry, as we said, is a bullish continuation pattern. So we'll enter long only once we confirm our pattern, our formation. The target can be set at the same distance as base of the cap and breakout point, and stop loss will be set below handle's lowest price. So I will go to the example exactly now. This is a hourly chart on euro yen. So I have confirmed my cap and handle. I was waiting for this for a new high price, and I noticed that high price over here, where it was higher of the initial move and higher of my handle as well. So I entered the market at this area over here. Sorry. So at this point over here, I enter long. I always have to set my stop loss at the lowest price of the cap. So my cap is at this area over here. The lowest prices have been identified over here. So I have set my stop loss at this point at 123.74, and I have to set the target from the entry point this time up. I'm sorry. So the distance from the bottom of the cap, which is also my stop loss, up to my initial high. So I'm measuring this distance. So as I said, let's read it again. So target would be set at the same distance as the base of the cap and the breakout point. The breakout point is where we have a new higher high, which is higher than the initial upwards move. So I have actually measured the distance bottom of my cap until the breakout point, which is here. So I have measured that, and I put the same distance from my entry point up to the target. So I enter here. I try to set my target at the same distance as the distance between breakdown and the bottom of the cap. So that was our cap and handle pattern, which it would be only bullish, as I said. Let's go quickly. What time is it? Oh, we're running out of time. So let's go quickly to the rounding tops and bottoms. So rounding tops and bottoms, it's what is they actually called. So we'll see a rounded top or a rounded bottom. So we will see actually the price creating like nearly 180 degrees round, half circle. Okay, similar to a half circle. Don't take that for granted. It will be a U shape, as I'm saying in the slides. Present similarly to a U shape, an inverse U shape or a standard U shape. So it's a reversal patterns as well. So a rounded top can be identified in an uptrend, and it gives us a signal that our asset will probably go downwards, and it's consistent by an uptrend, a rounded top, and a neckline. So I have to set a neckline as well. The rounded bottom can be identified in an uptrend. Sorry, in a downtrend. That's wrong. It says that the downtrend may have been entered and asset may reverse upwards. So let's go in the examples that they are more helpful. So rounded top, I was in an uptrend, as you can see clearly in the pound cable, pound cut daily charts. I was in an uptrend. However, my asset was the bulls in this asset were pushing higher and higher and higher, and they had a consecutive many actually bullish candles. However, at this area over here, they have been identified to go down. So the sellers starting entering the market, that they push the asset lower. However, we weren't sure if weren't sure that this is a reversal signal. So we're waiting for that rounded top to be confirmed. So why is it calling a rounded top? Because it's like U. It's like the letter U, but inverse U in this rounded top. So you see, it's clearly like the same way that it went up, it goes down the same, like with the same slope. So it creates that U, that rounded top. So I wasn't sure if it is going to be indeed a rounded top, so I was waiting for this neckline to be confirmed. So I had the neck to be actually confirmed and to break downwards. So at this area over here, it was consolidated, it was hidden 1, 2, 3 times, and went bullish again. So at this area over here we didn't have a fully formed rounded top. So we did have the rounded top once it break the neckline once, and then in the next day it opened below the neckline and further down actually, and it pushed further down, making a new lower low at 1.69 actually. So here we have a rounded top example, and it's it's a recent one. It's of May. It was fully formed on 18th of June. So that was a rounded top. And let's see also the rounded. Oh no, okay. So let's see the trading method of this rounded top. As I said, we set our neckline, which is our support line, because it is a support line because it was hit too many times. It was hit 1, 2, 3, 4, 5, 6, 7 times. So I set my neckline over here, which was my support line. However, I couldn't enter the market because I saw a consolidation and then a retracement upwards again. So I was waiting to be sure that the rounded top was confirmed. It was indeed confirmed. Once the neckline was broke, my the price closed below my neckline, and the very next day, the pair didn't manage to break above that neckline. So it closed further down at this area over here, and it didn't manage to go higher than my neckline. So I entered the market here. You could confirm this entering position with a smaller time frame. So here I have a daily one, which I see clearly the rounded top and the neckline. However, if you go in a 4-hour one, you will see consolidation actually of this neckline. So you see many times that it was hit again, but they didn't manage to break above that. So you confirm that it was indeed a good support, a good that it was reverted to a good resistance level. So once I confirmed that the neckline was a resistance level, I entered the market short this time. I set my target at the same distance as the neckline with the highest price in my rounded top. So since I confirmed that the neckline was becoming a good resistance level, I set my stop loss above my neckline, and I chose this area over here because it was hit too many times. It was hit too many times, and the pair didn't manage to go up to that point, up to that high for like 1, 2, 3, 4, 5. Like if this is a very sharp downwards move, so by seeing the second bearish candle, you can identify that it's very, very unlikely to go back upwards because we have two big bearish candles with small, actually quite small regarding their size, quite small up tails. So it was confirmed. You could either enter the market once you confirm the short position with this second candle over here that was pushed by sellers very, very sharply down. Okay, I said target is still at the same distance as neckline and the high of the round top. And let's see an example also of the rounded bottom. So we are in a downtrend. We saw a rounded bottom. So my asset, the euro pound one, which is actually okay. This is quite old example, but I didn't manage to find a rounded bottom pattern quite recently, so I put this example. So I saw that rounded bottom. I saw that the pair didn't manage to hit that resistance level over here. It was hidden once, twice, but it didn't manage to break it. So I set this resistance level as my neckline. Once I saw that it was broken, I started to believe that is going to be a rounded bottom. So I was waiting for the second candle to confirm this this rounded bottom. So I enter once my first initial candle closed above my neckline, and the second candle also closed above my neckline. So my neckline was becoming a support level. However, I entered the market in this example over here once I confirmed that it's a good the neckline is a good support level. So I left it consolidate for a while. So I saw that it can go down again. So because it didn't get closer to the neckline, so I entered long with stop loss below my neckline and the target at the same distance as neckline and the bottom of my rounded bottom, the lowest price of my rounded bottom. So that was our charting patterns, which are quite advanced ones. Please, if you have any questions, just let me know. We have run out of time. If there's something that I cannot answer right now, just email to me. So I will go through the next webinars until leave some time for you to ask anything you want. So our next webinars will be tomorrow. Again, with me will be trading divergence. And will be part 2. Actually, in the first trading divergence webinar, I introduced the power of divergence with stochastic oscillator, but this time we'll see how we could identify hidden divergence and like to see how we could use a combination of oscillators in order to enter the market. Also, this week we'll see from blue sky the support and resistance with where to set your support and the resistance when trading forex. Also, Stuart will be back next week and giving live analysis. This is a very, very important webinar because you can ask him that particular day for the pair, the currency pair that you're interested in, and to ask his opinion. Also, Stuart will have an Elliott waves theory part 2, and for the last webinar for the month, it will be top reversal patterns and how to know when the market will turn. We have a last question from Kostan. What about triangles? Because unfortunately I'm run out of time. However, triangles have been covered last month from Stuart. I could email you the link, or you could get into our website. Actually, the website is here. You can see this is our website with the webinars, so you can go down and click here to view our past webinars. So by clicking here, you could be able to watch Stuart's webinar on triangles. That was a very, very helpful webinar because triangles can be identified more recent than the ones that we covered today. So that was all from me for today. Thank you for watching. Hopefully you find the webinar helpful. And for those that are interested in divergence, and I will see you tomorrow with hidden divergence and try to combine many oscillators together for a better confirmation of our entry in the market. Thank you for attending on my webinar, and see you tomorrow. Thank you very much. Bye-bye.